Good morning, everyone. How are we doing today? It is Friday, July 3rd, and it is a long weekend for lots of us out there. So make sure you enjoy it. We are celebrating our freedom this weekend, which is never should never be taken for granted. Certainly, we're in some muck and mire today as a country, but we will certainly get through it. This we've been through worse things in the past, and I have every confidence we will get through this. Before we get into the daily news, I do want to remind you of a couple of things. First and foremost, my book report challenge is out. This is something I intend to help foster communications between adults and I'll just call them children. I want to do this because I believe money, investing, financial freedom is not an easy topic to discuss between adults and kids, usually parents and children, but heck, it could be uncles, aunts, neighbors, coaches, whatever it is. If we can foster that communication, if you have a teenager that is entrepreneurial or someone that you're in the real estate business and you want to give your kids a leg up, take the challenge. Read the book. I am going to give out at least $200, so two winners for the best book report. I am not a hard grader. I will grade on a scale. Last time we did this, we had someone as young as 7 or 8 submit a book report, which was just darling. So again, I think money is important. I wish we had talked about it more as I was growing up. Specifically, not money, but investing, right? I think money is a topic, but money is a topic because, hey, I want an Xbox. I want a this. I want a that. Let's talk about investing. So I did this before. I was very happy to get the book reports I got, but I wasn't inundated. Part of that was because this channel was still pretty young over a year ago when we did it the first time. I'm hoping to get hundreds of these. So $100 cash money, sit in a thank you card for the best two. And last time I ended up sending out more than two, but I will send out at least two that you have my word on. And second, don't forget, we have a requirement to get to 110 thumbs up on these daily videos. Today might be rough. I'm not sure we're going to do it. So prove me wrong. All right, today is a day off for lots of folks, so maybe we don't get the same viewership on these videos. But I'm going to keep doing them, and we will see where we get. And if we don't get to 110, I get an hour back of my day tomorrow. So I have every confidence we get there. Leave your questions below, and we will talk hopefully tomorrow at 8 o'clock during a YouTube Live. So on to the kind of the topics of this morning. First and foremost, as I said in the title, we never can forget, at least in my opinion, one of the things that has made America great over the years is hope, not fear. And we need to remember that we have been through some terrible things in our history, right? We went through a terrible Civil War. We went through a Great Depression, frankly, 2 world wars. We had double-digit interest rates. We've had gas shortages. We've had the dot-com crash. We've had 9/11, and so on and so forth. And each time, while it felt bad in the middle of it, we came out the other side stronger as a country. And I know there's a lot of stuff going on right now that talking about the America decline and all of that. I guess it's certainly possible that it's out there, but I think that is just fear. That's a few people out there pushing an agenda, and I think it is nonsense. I believe if we band together, we move forward, we remember hope, not fear, we will get to the other side. That is not to minimize the pain, the stress, the, you know, all of that, but, you know, we have to keep moving forward together. So that's just something I wanted to bring out there. The big topic for today for me is what are the key second half questions? On this channel, right, we talk about real estate, we talk about what the consumer's doing, we talk about cost of capital. It's kind of the mid-year. It is mid-year, frankly. So what am I looking at? And this is ever changing, and that's why we talk every day. So I think there's a couple of key questions. I'd love your feedback on them. If you want to take notes, these are my key questions. I'll give you my thoughts, but if you want to leave your thoughts in the comments, that would be great. First one is interest rates. I think when we talk interest rates that impact you and I, it's 30-year mortgage rates, and those are going to go down or stay down. They'll be under 3% by the end of the year. They are already in many cases, but I do not see those rising. Again, this is for the end of the year. So I do not see that happening. The other way it impacts you and I is savings rates and stuff in our banks, and I don't see that rising either. So I think interest rates, to quote Jerome Powell, Fed chair, they're not even thinking about raising rates. They're not even thinking about raising rates. So I think that is a pretty good certainty that interest rates are going to remain low without question. Next up is unemployment. Unemployment, we've talked about a couple of times, trying to look into our crystal ball, and mine's just as broken as yours. It's, I was on record probably 6 weeks ago, maybe saying, hey, it's going to be tough to get under 10% by the end of the year. And, the numbers that came out, I think it was yesterday, 11.1. I don't know. We might be able to get under 10%. That'd be huge. Not to diminish the 9% that's still unemployed, but to snap that back would be interesting. And yes, I understand. I get lots of comments about you actually believe the unemployment number and you're such an idiot and all that stuff. I'm only using the numbers that are published, right? I don't want to get into the math or lack of math in those numbers. We have to look at some data points, and if you look at them over long enough, whether they're right or wrong, the information is meaningful. So that's what I look at. Again, the published rate is 11.1. So what do you think? Do you think we get under 10% by January 1st of this year or next year? I think that's an interesting discussion, because that just tells you what's going on with the consumers, right? So are they scared? They getting aggressive? What's going on? So I think that's interesting. Next up is home prices. Here's a crazy one. I think in many markets, if not most markets, ex San Francisco, ex New York, right? So the vertical cities are in trouble, and they're excluded from this. I think a lot of the U.S. market, given the flight from high taxed areas in vertical cities, are going to see price increases because we've underbuilt suburbia, right? Because there was a trend the last 5 or 6 years or a decade to go to the cities, and now space is good, backyard's good. Want the extra bedroom for the office, all of that. So, I really think, when they post median prices, I think they're going to go up. They were Case Shiller this week sometime talked about last month being up 5%. It wouldn't shock me if they continued to rise even in a pandemic. It's real estate's an amazing thing, right? We are going to see qualified buyers take advantage of rates below 3%, get into a fixed rate mortgage, and frankly look like geniuses in a couple of years when inflation comes back. So those are the things that I'm looking at, and I'm trying to figure out, because again, I'm not done growing. I want to buy more investment properties. Specifically, I want to buy houses. I do believe that the commercial market, even multifamily, office, retail, is in big trouble. I'm seeing more and more pain in that market, but it will take so long to unwind. We won't be able to pick it up till next year. So I'm going to be buying houses. But please remember, I have 20 years of history looking at my market. So do your homework. This is a tough time to be a new investor. If you're just looking at your market, you're looking at a market, at least in most cities, with artificially low supply. And if you're just starting to look, you won't know that. So you'll see bidding wars and first day listings go pending, and you'll be confused. So this is a dangerous time in many cities. So please take my word for it. Do your homework. If you need help, there's a playlist on this channel called the 75-Day Hard Challenge. It's completely free. It's 8 activities you have to do for 75 days to learn your market. If you need more specific help, you want to understand the math and how I learn my market, I put out that cheap course for $199, link below. Take a look at it. So it is interesting. Got a comment here. Yeah, prices are going up pretty substantially in my market as well. And that's why I'm trying to be cautious. You'll see in a minute. I actually took some data down about median home prices just to tell you how nutty they could get. So pay attention for that because I agree with you. This is a dangerous time to invest if you're new. It's frankly a dangerous time if you're experienced like me, but I'm happy to say no and sit tight, which is comfortable. So please be careful. I'm here to help. We have the course below, which is cheap. Um, yeah, bidding wars are crazy. And if you want you mentoring from me, I don't do one-on-one mentoring. I don't. I value my time and I want to help everybody. So the course, and then every Saturday at 9 a.m. we do a student-only session where we answer specific questions. So it's the best thing I've done, and it makes me happy to see everybody signing up, and that's growing every week. So in the end, know it's there for you. A couple other things going on is I wanted to talk about that median price because I think, again, it's so early, it's hard to say, but I wanted you to understand this feels like 2004 to me, right? No, 2002 to me. So I went back to my market, just Fresno. I suggest you look at your market. And actually, this is California. Sorry, I couldn't find Fresno only this morning, so I took California. But watch this. So if you assumed California's market was, I did an easy math at 100K, and you walked it through 2002, 2003, 2004, just realize the amount of appreciation that could be ahead of us in some markets. 2002, it appreciated 20.5%, 20.5. Follow that by a year of 17.5%. Follow that by a year of 21.5%. So that's 2002, 2003, 2004. That's not crazy lending, nonsense, which made it go bananas in 05, 06. This is a 20% year, a 17% year, and a 21% year. Now, that is very California, right? It's a very up and down market. But do yourself a favor, go back and look at that period for your market and understand what might be happening. Because this is feeling like a setup, at least for Fresno, because it's the only market I know in detail, that we could have years of a double digit appreciation. So if you want to put that in context, if you came into 2002 with a house worth 100 grand, the first year it would be worth 120. The second year it would be worth 141, and the third year it would be worth 172. So in 3 years the house goes from 100 grand to 172. We could be set up for that run again. And if you know our story, I wrote about the first house we bought, Norris Drive, for 107 grand. And by 2004, we refied it, and in 2005 we sold it for 264. I'm telling you, because if that's a big capital IF, right? If inventory stays low, we're going to see double digit appreciation. It's just going to happen, right? The demand, even with double digit unemployment, is just too high. So again, it's dangerous. Do your homework, understand the math, know what a bad, average, good, and great deal are. And if you need help, I'm here for you. Link below. So again, go back and do your research. Don't only look at 12 listings and go, hey, let's buy the yellow one. That's not how this works. Another thing we've talked about on this channel a lot is mortgage apps. They were actually down 2 weeks in a row. They're down 1%, but still down in 2 weeks in a row is meaningful. But realize while they are down 1% week on week, they are up, yes, up 15% year on year. That is mind boggling to me, right? Last year, this time, last summer, we're up 15% from last summer. Are you freaking kidding me? I can't believe that. So, something to watch. Demand is real. Supply is low. Prices are going up, right? Just remember, we went from a 100K house to 172 in 3 years. And in my example, we went from 107 to 264 in 4 years. It's out there. Another couple things that caught my attention. There was another IPO yesterday called Lemonade. It's an online insurer. And why it caught my attention is it was up 140% day one. This was pretty common back in the dot-com days where stocks were up 1, 2, 300% in a day. But just remember, when that happens, when these are mispriced, the company actually loses because they didn't raise as much as they should have. And the winners, of course, are the people that got in early, right? That got the friends and family shares. So it's not a very, it's not capitalism; it's favoritism. So that kind of stuff annoys me. And then the last thing, I don't know about you, but I didn't feel good about Wednesday's market activity and Thursdays. If you remember Wednesday, I think I came on and said, "Hey, lots of great news," right? That was the day Pfizer announced their, what was it, 24 for 24 immunity thing and all this other good news. And then Thursday we come out with blockbuster employment numbers, right? The fall, was it 2.5 million or something like that of jobs, or growth in jobs. The rate fell from 13.3 to 11. And then the market sold off into the weekend, or yeah, into the close. So the question for me is, was that sell off just like the last couple of Fridays where nobody wants to hold the weekend because of the headline risk? Probably. But also, we've had two interesting trading days where the news was good and the market didn't pop. So for me, that kind of tells me we might be stretching the upper limits, right? Because again, Thursday, I think I came on and said that everything is good, right? I expected the day to be bigger, especially with Pfizer's news. And then yesterday, the opening was strong and it just sold off to the end. So I'm wondering what's going to happen next week. Do we just stretch the out of bounds? We're bumping up against the 200-day moving average. Or is it simply, it's the weekend, nobody wants headline risks, it's a 3-day weekend, it's longer. So I don't know what's going on. So that did bother me. I didn't want to bring it up yesterday. I just wanted to celebrate a good day and moving on. But it did concern me. So in the end, that's what I have for you today. Have a wonderful day. I have an interview from a subscriber who I believe is bringing on his son here in a few minutes. So that should be fun. All right, everybody, take care of yourself.